The former Quebec hydroelectric grid supplied roughly 10% of New York State's total electricity needs. That number does not sound alarming until you understand what it replaced. When New York shut down the Indian Point Nuclear Energy Center in 2021, it eliminated 2,069 megawatts of carbon-free baseload power that had been keeping the lights on in the Hudson Valley and Manhattan for decades. Policymakers pointed north to Quebec and said the gap would be filled by clean Canadian hydropower flowing through a new $6 billion transmission line buried beneath the Hudson River. That was the plan. That was the promise. That was the foundation on which billions of dollars in real estate lending, commercial development, and regulatory compliance strategy was built. And that foundation is now cracking in ways that the mainstream financial press has not yet connected to your mortgage payment, your property tax bill, or the balance sheet of the regional bank holding your savings. This is not a story about the power grid. It is a story about what happens when the physical assumptions underneath a $21 trillion real estate market turn out to be wrong. It is a story about leverage built on a forecast that no longer exists, about insurance actuaries quietly repricing risk in markets that have not yet received the memo, and about a refinancing wall of $1.5 trillion in commercial real estate debt that is coming due into an environment that has fundamentally changed since those loans were written. Canada did not flip a switch. There was no single dramatic moment. What happened instead is what always happens in a structural breakdown. The pressure built quietly, incrementally, invisible to anyone watching the daily headlines, until the gap between the financial model and physical reality became too wide to bridge. Hydro-Québec is a crown corporation owned by the province of Quebec. For decades, it operated with enormous surplus-generating capacity, selling that excess power to New England and New York at rates that made the economics of closing American power plants look sensible on a spreadsheet. That era is over. The utility's own strategic plan, published and available to any analyst who chose to read it, projects that Quebec will face domestic energy deficits by 2027 unless it builds significant new generation capacity. The drivers of this reversal are not mysterious. Quebec successfully attracted a wave of energy-intensive industries over the past 5 years, including cryptocurrency mining operations, aluminum smelting expansions, and battery manufacturing facilities, all drawn by the promise of cheap, clean power. Simultaneously, the province launched an aggressive electrification program for its transportation and heating sectors, spiking domestic demand at exactly the moment when industrial consumption was also climbing. The surplus that American planners priced into a $6 billion infrastructure investment has been absorbed by Quebec's own economic growth. Michael Sabia, the chief executive of Hydro-Québec, stated publicly that the era of limitless surpluses is finished. That statement received minimal coverage in the American financial press. It should have moved markets. The Champlain Hudson Power Express, the transmission line designed to carry up to 1,250 megawatts of Quebec hydropower into New York City, was already facing construction delays and cost overruns before the supply picture in Quebec deteriorated. The line is structured as a regulated asset with contracted revenue tied to power deliveries. If the power does not flow at contracted levels, the revenue does not materialize, and the financing structure built around that revenue comes under stress. The investors who bought the bonds backing this infrastructure made a bet on a supply source that is now competing with domestic Quebec demand. Under Hydro-Quebec's own operational protocols and Canadian law, the utility is obligated to serve its domestic customers before exporting a single megawatt to foreign buyers. This is not hostility, it is sovereign responsibility. And it means that during the precise moments when New York most needs imported power, during a polar vortex or a summer heat dome that drives peak demand, Quebec will curtail exports first. The American grid operator ISO New England has documented this risk in its resource adequacy assessments for years. The North American Electric Reliability Corporation flagged the New England region specifically as facing elevated risk of capacity shortfalls during extreme weather events. These are not fringe forecasts from alarmist researchers, they are the official assessments of the organizations responsible for keeping the lights on. Now connect that physical reality to a financial structure. New York City passed Local Law 97 in 2019, establishing carbon emissions caps for large buildings with penalties beginning in 2024 and escalating sharply through 2030. A building exceeding its emissions limit faces fines of $268 per metric ton of carbon over the threshold. For an older Class B office tower of 500,000 square feet, that penalty can easily reach $2 million per year. Building owners understood this math and constructed a compliance strategy around it. The strategy was to purchase Tier 4 renewable energy credits generated by the Champlain Hudson Power Express, matching the clean Canadian hydropower flowing into the grid against their building's consumption. It was cheaper on paper than replacing boilers, installing new windows, or retrofitting HVAC systems in buildings that were already struggling with high vacancy rates. If the power does not flow, the credits do not exist in sufficient quantity, or they trade at scarcity prices that make the compliance strategy economically equivalent to just paying the fine. Either path destroys the net operating income of buildings that were already mathematically stressed before this variable entered the equation. The commercial real estate sector was already sitting on an unacknowledged crisis before the energy dimension arrived. Over $1 trillion in commercial real estate loans originated at near-zero interest rates are maturing through the end of 2026, requiring refinancing into an environment where the Federal Reserve's benchmark rate spent most of the past 3 years above 5%. A building that generated sufficient cash flow to service debt at 3% interest often cannot cover the payments at 7% on the same loan balance. The debt service coverage ratio, the ratio of net operating income to annual debt service, falls below 1, meaning the building cannot pay its own bills. Banks holding these loans have two choices. They can foreclose, take the property onto their balance sheet, and recognize the loss immediately, or they can extend the loan, grant the borrower additional time, and defer the recognition of a loss they already know is there. The industry term for the second approach is extend and pretend, and it has been the dominant strategy since 2023. Regional banks, which hold approximately 70% of all commercial real estate debt in the United States, have been quietly modifying loans, granting extensions, and avoiding the write-downs that would force them to raise additional capital or acknowledge insolvency. New York Community Bank provided the financial market with a preview of this dynamic in early 2024. After absorbing the assets of Signature Bank, the institution disclosed unexpected losses tied to its commercial real estate portfolio, and the stock fell more than 60% within days, briefly triggering a crisis of depositor confidence. The bank survived with a capital injection, but the episode revealed the fragility concealed inside balance sheets that regulatory filings had presented as sound. What happened at New York Community Bank was not an isolated incident, it was a diagnostic. The same pressure exists across dozens of regional institutions with concentrated exposure to office, retail, and multifamily assets in markets where fundamentals have deteriorated. When the energy compliance cost is added to buildings that are already operating below break-even, the timeline for loan defaults accelerates. The landlord, who was hoping to hold on until rates declined, now faces a new annual liability in the form of Local Law 97 penalties that were not in the original underwriting model. The bank that extended his loan did not underwrite that liability either. And the insurance carrier that wrote the property and casualty policy on the building is now repricing the premium based on an updated assessment of the property's financial viability as a going concern. The insurance dimension of this story has received almost no attention in the context of the energy crisis, and it is where the transmission from commercial stress to residential damage begins. State Farm and Allstate announced their withdrawal from new homeowners insurance policies in California in 2023, citing wildfire risk and reconstruction costs. The same logic is now being applied by actuaries to flood-prone coastal properties in Florida, Louisiana, and the Carolinas. But the withdrawal of insurance capacity from these markets does something that interest rate analysis alone cannot explain. It severs the connection between a property and mortgage financing. A lender will not originate or maintain a loan on an uninsured property. If you cannot get insurance, you cannot get a mortgage. If you cannot get a mortgage, the property is only worth what a cash buyer will pay, and cash buyers extracting a distressed asset discount will pay a fraction of the prior appraised value. This mechanism converts an insurance underwriting decision into an immediate property value impairment without any transaction needing to occur, without any headline, without any visible crash. The value destruction happens on the actuarial tables, not in the trading pits. In Florida, the average homeowner's insurance premium has tripled in 4 years for properties in coastal counties. For a household that purchased at the peak of the 2021 market with a 30-year fixed mortgage, the monthly escrow payment has increased by hundreds of dollars since closing, a cost that was not included in the debt-to-income calculation the underwriter used to approve the loan. The Federal Housing Finance Agency has documented this phenomenon, noting that insurance cost increases are now a primary driver of payment stress in markets previously considered stable. Households with locked-in 3% mortgage rates are discovering that their effective cost of ownership has risen 15 to 20%, not because rates changed, but because the ancillary costs attached to ownership have repriced dramatically. When those households face a liquidity event, a job loss, a medical expense, a divorce, the forced sale enters a market with compressed buyer pools because the insurance premiums that new buyers would face further shrink the universe of qualified purchasers. This is not a crash arriving as a visible event. It is a repricing cycle compressing values quietly across millions of balance sheets simultaneously. Now add the energy cost dimension to the residential picture. States in the Northeast, particularly Massachusetts, Connecticut, and New York, carry among the highest residential electricity rates in the continental United States. The ISO New England Grid Operator's own data shows that wholesale electricity prices in the region correlate directly with natural gas availability during peak demand periods, because the region relies on just-in-time gas deliveries and import capacity rather than dispatchable baseload reserves. When a polar vortex reduces temperatures across the Northeast simultaneously with periods of low wind generation and constrained pipeline capacity, The marginal cost of electricity spikes by multiples. These price spikes are absorbed by the utility as a short-term imbalance that gets socialized into rate-based calculations over the following regulatory period, appearing on your electricity bill 18 to 24 months after the event that caused them. Residential electricity rates in Massachusetts have increased approximately 40% over the past 4 years, and the structural drivers of that increase have not been resolved. They have been deferred. The Champlain Hudson Power Express was supposed to be part of the solution. The weakening of Quebec's surplus position means the solution is incomplete. For a family that purchased a home in the Boston suburbs in 2022, the monthly carrying cost has increased substantially beyond what the mortgage payment alone would suggest. Property taxes in many communities have been reassessed upward to reflect the nominal appreciation in values that occurred during the pandemic. Insurance premiums have risen, electricity rates have risen, the median hourly wage has not risen at a pace that absorbs these compounding increases. The Federal Reserve Bank of Atlanta publishes a homeownership affordability monitor that tracks the share of median income required to purchase a median-priced home in each metropolitan area. Across the Northeast, that percentage has exceeded 40% in multiple markets, a level that historically precedes meaningful price corrections as the pool of qualified buyers shrinks below the level required to sustain current valuations. The lock-in effect, the reluctance of existing homeowners to sell and surrender their sub-4% mortgage rate in exchange for a new loan above 7%, has suppressed transaction volume and masked this demand destruction with apparent price stability. But price stability in a market with near-zero volume is not the same thing as price stability in a functioning market. It is a stalemate sustained by the unwillingness of sellers to accept what buyers can actually afford to pay. The mechanism that breaks the stalemate is time. Death, divorce, job relocation, financial distress, and estate settlement force transactions, regardless of where interest rates sit. The volume of forced sales has been building slowly since 2023, as the pandemic-era financial buffers that households accumulated have been consumed by the sustained cost of living increases documented across food, energy, and healthcare. Credit card balances in the United States crossed $1.1 trillion in late 2023, a figure that the Federal Reserve Bank of New York described as historically elevated relative to income levels. Delinquency rates on credit cards have risen for 8 consecutive quarters, now exceeding the levels seen in the immediate aftermath of the 2008 financial crisis for the under 40 age cohort. This is not the profile of a consumer population that can absorb a 15 to 20% increase in housing operating costs without behavioral change. The behavioral change, when it comes, takes the form of deferred maintenance, delayed property tax payments, and ultimately decisions about whether to continue servicing a mortgage on a property whose carrying costs have risen far above the level the original purchase decision assumed. The commercial real estate and residential markets are not separate systems. They are connected through the regional banking sector, through the property tax revenue streams that fund municipal services, and through the insurance and credit markets that price risk across both asset classes simultaneously. When the vacancy rate in a downtown office district exceeds 35%, as it has in San Francisco, the city's property tax assessment for that district must eventually reflect actual market transactions. The reassessment process is slow and politically contested, but it is inevitable because assessed values that bear no relationship to market prices create legal challenges from property owners and distort the capital allocation of every lender underwriting loans in that market. When the tax-based contracts, municipal budgets face pressure. When municipal budgets face pressure, the choices are service cuts or tax increases on the remaining solvent taxpayers. Both outcomes reduce the attractiveness of the jurisdiction to the households and businesses that constitute the demand side of the housing market. San Francisco provides the most advanced version of this case study. The city's office vacancy rate reached 35.8% in the fourth quarter of 2024, according to data from the commercial real estate services firm CBRE. The total value of assessed commercial property in the downtown core has declined by billions of dollars. The city faced a budget deficit of approximately $800 million in its 2024 fiscal year, requiring cuts to public safety, public health, and infrastructure maintenance. The feedback loop between commercial vacancy, fiscal stress, service deterioration, and further population and business departure is not theoretical in San Francisco. It is documented in annual budget reports and migration data. New York and Chicago are following the same trajectory at a lag of approximately 2 to 3 years, and the energy cost dimension is a new compounding variable that was not present in San Francisco's version of the cycle. The banking sector exposure to this cascade has been the subject of quiet concern among regulators since the regional bank stress events of 2023. The Federal Reserve's Financial Stability Report, published twice annually, has consistently flagged commercial real estate as the primary area of potential stress in the regional banking system. The specific concern is the concentration risk. Smaller and mid-sized banks, which lack the geographic and sector diversification of the largest institutions, often have commercial real estate loans representing 30, 40, or even 50% of their total loan portfolios. The capital buffers required by current regulations were calibrated against historical loss rates for commercial real estate, which were in turn calibrated against an interest rate environment that no longer exists. A loan originated at a loan-to-value ratio of 65% at 2021 valuations may sit at a loan-to-value ratio well above 100% at 2025 transaction prices in the office sector, meaning the collateral securing the loan is worth less than the loan itself. This is the textbook definition of an underwater asset, and it exists across thousands of line items on the balance sheets of hundreds of regional institutions. The extend and pretend strategy works until it does not. The specific mechanism that ends it is usually either a regulatory intervention, forcing banks to mark their portfolios more accurately, or a capital market event, such as a credit rating downgrade that raises the bank's cost of funding above a level its loan book can support. Moody's and S&P have placed multiple regional banks on review for downgrades specifically citing commercial real estate exposure. A downgrade to below investment grade status triggers covenant violations in the bank's own wholesale funding agreements and forces institutional depositors with mandates requiring investment grade bank counterparties to withdraw their funds. This is the digital bank run operating through the wholesale funding channel rather than the retail deposit channel, invisible to most observers until the institution announces that it requires emergency capital. The sequence from downgrade review to liquidity crisis can compress into a period of weeks when market participants are already sensitized to the risk. The connection to the Canada energy story runs through the timeline. The Champlain Hudson Power Express was originally scheduled to begin delivering power to New York City by 2025. Those timelines have slipped. The concurrent deterioration in Quebec's surplus position means that even full completion of the transmission line delivers less certainty of supply than the original financial models assumed. Landlords who structured their local Law 97 compliance strategy around Tier 4 renewable energy credits from this line are now recalculating their exposure. The buildings most exposed are the older Class B and Class C office properties in Midtown and Lower Manhattan that were already struggling with high vacancy rates and deferred capital expenditures. The local Law 97 penalty on top of a below-market rent environment and a loan maturing at 7% creates a financial profile that no equity sponsor can rationalize continuing to support. The rational decision is to return the keys to the lender exactly as Blackstone did with its Stuyvesant Town mortgage in 2010, and exactly as multiple institutional sponsors have already done with specific office assets in New York, Chicago, and San Francisco over the past 18 months. The insurance market is already incorporating this deteriorating outlook. Commercial property and casualty premiums for office buildings in the Northeast have increased dramatically, with some carriers declining to renew coverage at any price for assets with high vacancy, deferred maintenance, and uncertain compliance trajectories under Local Law 97. An uninsurable commercial building cannot be refinanced. An unrefined commercial building with a maturing loan faces immediate foreclosure. The sequence is mechanical, and it does not require a dramatic triggering event. It requires only time and the continued absence of the conditions that would reverse it. Specifically, a sharp decline in interest rates, a recovery in office demand, a resolution of the Quebec supply question, and a relaxation of Local Law 97 enforcement. None of those conditions appear imminent based on current policy trajectories. The municipal bond market is pricing this risk with a discount that fixed-income analysts are beginning to describe as a Northeast penalty. Bonds issued by New York City, Boston, and Chicago carry yield spreads above comparable maturity treasuries that have widened over the past 3 years. The spread widening is modest by crisis-era standards, which is precisely what creates the asymmetric risk profile. The market is not yet pricing a fiscal crisis. It is pricing elevated uncertainty. But elevated uncertainty in a market with constrained liquidity and concentrated institutional ownership can transition to distress pricing quickly when a catalyst arrives that resolves the uncertainty in the negative direction. An energy shortfall during a severe winter, a wave of Local Law 97 penalty assessments landing on already distressed landlords, a regional bank credit rating downgrade triggering a depositor response, any of these events functions as the catalyst that converts the spread widening into a repricing. The residential market sits downstream from all of these pressures. The household that purchased in a northeast suburb in 2022 is not directly exposed to commercial real estate lending or municipal bond spreads, but they are exposed to the property tax that funds the municipal services, whose fiscal health depends on the commercial tax base. They are exposed to the electricity rate that reflects the grid's inability to source cheap baseload power from a Quebec that is running short of surplus. They are exposed to the homeowner's insurance premium that reflects the actuarial community's updated assessment of regional risk. And they are exposed to the mortgage market liquidity that reflects the regional banking sector's appetite for new originations at a time when existing loan portfolios are under stress. The lock-in effect has suppressed the visible signal of this pressure for 3 years. When sellers do not sell, prices do not decline, and the market appears stable. But the cost of living data, the credit card delinquency data, the retirement account hardship withdrawal data, and the insurance premium data are all telling the same story beneath the surface of the transaction prices. The households most exposed are not the wealthy owners of luxury properties. They are the households who stretched to purchase at peak valuations in 2021 and 2022, using low down payments and the full extent of their qualifying income, leaving no margin for the compounding cost increases that followed. Their nominal equity position is thin, their monthly cash flow flexibility is limited, and their assets sit in a market where buyer demand is structurally constrained by the same cost pressures they themselves are experiencing. The policy responses available to address this accumulation of structural stress are constrained in ways that did not apply in prior cycles. The Federal Reserve cannot reduce interest rates to rescue real estate collateral values without risking a reacceleration of the inflation that it spent 3 years and significant economic pain to suppress. The federal government cannot deploy fiscal stimulus at the scale required to offset the private sector credit contraction without adding to a deficit trajectory that is already consuming interest payments larger than the entire defense budget. The state governments of New York and Massachusetts cannot relax their building emissions regulations without political costs that their current majorities are unwilling to accept. And the province of Quebec cannot manufacture surplus hydroelectric capacity on a timeline relevant to the current financing cycle of the buildings and infrastructure projects that were designed around it. What remains is the process of adjustment. Adjustment in this context means repricing. It means the commercial real estate market finding transaction prices that reflect actual cash flows at actual interest rates, with actual energy and compliance costs included. It means regional bank balance sheets eventually reflecting the market value of their collateral rather than the origination value. It means municipal property tax revenues adjusting to reflect the commercial market correction on a lag of 2 to 4 years as the reassessment process works through the pipeline. It means residential prices in the Northeast finding a level that is achievable by buyers facing the actual cost of ownership in 2026, including mortgage rates, property taxes, insurance premiums, and electricity bills. The data supporting the direction of this repricing is consistent. Transaction volume in commercial real estate is at its lowest level since the aftermath of the financial crisis. Office vacancy rates in the major Northeast cities are at or near historical highs. Regional bank loan modification activity is elevated. Insurance availability for certain property categories is contracting. Electricity rates in the region are on a trajectory of continued increase. The Quebec surplus that anchored a significant portion of the region's clean energy compliance strategy is no longer available in the quantities the financial models assumed. These are not independent observations. They are connected elements of a single structural adjustment that is unfolding across multiple markets simultaneously. This is not a collapse, arriving as a single visible event with a date that will appear in financial histories. It is a repricing cycle, operating through the mechanics of loan maturities, insurance renewals, tax reassessments, and utility rate cases, each one a discrete administrative process operating on its own timeline, adding its increment of adjustment to an asset class that has been supported by assumptions that no longer hold. The process is not complete. The refinancing wall peaks through 2026. The Local Law 97 penalty schedule escalates through 2030. The Quebec supply question will be resolved one way or another by the winter of 2026 and 2027, when peak demand in both markets will test the export commitment at the same moment. The bank examination cycle that follows the current extend and pretend period will eventually force recognition of the impairments that are currently sitting in modified loan portfolios earning interest at below market rates. The data continues to arrive, the contracts continue to mature. The physics of the grid operates independently of the financial model built around it, and the process of alignment between those two realities is still unfolding. What happens when a market reprices is not a mystery. It is the oldest and most reliable mechanism in economics. Capital flows to where it is accurately priced and away from where it is not. That flow is already underway in the data center market, where hyperscale operators are making location decisions based on grid reliability metrics that systematically disadvantage the Northeast. It is underway in the manufacturing sector, where the electricity rate differential between New England and the Southeast has reached a level that changes the capital expenditure decision for energy-intensive industries. It is underway in the residential market, quietly, in the delinquency statistics and the insurance renewal cancellations and the property tax appeal filings that accompany every downward valuation adjustment. The story of what Canada's energy constraints mean for American housing is not a story about a foreign adversary or a policy failure or a market crash that arrives in a single headline. It is a story about what happens when the physical assumptions underneath the financial structure change faster than the financial structure can adapt. The transmission line beneath the Hudson River is still being built. The Quebec surplus is still being consumed. The refinancing wall is still approaching. The insurance actuaries are still updating their models. The process is still unfolding and the data is still arriving. Subscribe if you want to follow it as it does.